Hello and welcome to a new episode of Under 360 English. Today we are going to discuss about how the inflation affects or impact stock market. We know that everyone are keen on listening the inflation numbers. When inflation rising, everyone are panic and even retail investors or large scale investors they start to sell. Have you ever wondered why market is panic on rising inflation or why everyone are keen on listening to the inflation numbers? Whether the inflation is that a bad thing? So in this episode we are going to analyze what are the good and bad things about inflation and how it specifically affect the stock market. So stay tuned, keep watching. So first let's have a look on what is inflation. So inflation is the gradual rise in prices of goods and services. So when the inflation rate increases, the cost of living also increases. So that eventually leads to a lower purchasing power of common public. For example, if apples are sold 100 rupee per kilogram in 2010, then in an inflating economy, that means if from 2010 to 2023 or 22, if the inflation is steadily rising, then they would cost more money after each and every year. So let's say the apple is sold at 200 kilograms in 2022. Therefore, in 2020, you could buy 10 kilograms of apple for rupees 1000. But today, your purchasing power will drop. Purchasing power will drop means now you can buy only 5 kilograms with the same amount. It's as simple as that. To take our understanding to a little in depth, so let's have a look on what basically causes inflation. So there are two primary reasons behind the increase in inflation. First one is demand is higher than supply. So there are times when the average income of people in an economy increases and they want to buy more products and services. During such times, the demand can increase above the supply of the any products. Okay, so there is a scarcity, there is a shortage of goods and services that causes buyers to pay more for them. This eventually results in general increase in prices. As demand increases, price increases. The second reason is the increase in cost of production. The inflation rate increases if the cost of production or goods increases due to an increase in cost of raw materials or manpower or tax or anything like that. So while this leads to an increase in cost of production, it also causes a drop in supply of the goods also. With the demand remains the same, the price levels tend to increase. So these are the two reasons. Now let's have a quick look on the impact of inflation on stock markets. The first impact is the purchasing power of investors. Since inflation by definition itself is an increase in price of goods and services, it also has an indicator of the decreasing value of money. So if the inflation rate is 5%, then 10,000 today will be worth of 9,500 after 1 year because 5% purchasing power has been decreased. So if the inflation rate increases 10%, then the same amount would be worth less in future. So the purchasing power of investors decreases as the inflation rate increases. This can have a direct impact on the stock market since investors would be able to purchase fewer stocks for the same amount. Second impact is the interest rates. When inflation rates increases, RBI, Reserve Bank of India, increases the interest rate for deposits and loans. The idea is to incentivize people to save money and avoid excessive liquidity brings the inflation rate down. Since loans get costlier, the cost of capital for companies increases. Hence, the projected cash flows are also valued lower. This results in lower equity valuations. The third impact is directly on the stocks itself. As the inflation rate rises, speculation about the future prices of the goods and services leads to a market environment that is highly volatile. Since prices are rising, many investors will speculate that companies will experience a drop in profitability. Hence, some investors might decide to sell the shares leading to a drop in their market price. At the same time, investors, some are optimistic about the companies which are making profits in the bright future. That kind of investors will buy such stocks, and eventually this cause a volatile market scenario. We know that value stocks are strongly impacted by a change in the rate of inflation. The market price of the value stocks is usually directly proportional to the rate of inflation. So, when the inflation rate rises, value stocks tend to perform better. On the other hand, growth stocks have minimal cash flows. Therefore, they have a negative correlation with the rate of inflation. The market price of the stock drops when inflation rates rise. Now let's have a look on dividend paying stocks. Then an increase in rate of inflation that causes a drop in the market price. This is because with rising inflation, rates, dividends that all fail to beat inflation, making such stocks less attractive to the investors. Finally, let's have a look on what are the good things about inflation. Don't think that inflation is always bad. In fact, a controlled rise in inflation rates, that's a sign of a growing economy. If you turn the pages of history, you can find that most of the occasions a rising inflation rate is somewhat going along with an improvement in GDP. It is also, you have to remember that if the inflation rates are very high, then the purchasing power totally can erode drastically, and that create adverse effect on economy. On the other hand, a deflation or very low inflation that eventually stall the economy. Economy will be somewhat standstill. Countries with very low inflation rates, they are experiencing such things. It won't grow at all. That will be standstill. Therefore, investors must compare inflation rates in recent years to assess if the increase is sudden or that sustained one. If the inflation rates are rising steadily, that can be a healthy thing. That's healthy for the business and the economy also, and obviously you need not bother in such situation. But a sudden spike in inflation, that's always a matter of concern. You should be concerned about it. Then about the present scenario, we know that the inflation is not in a very good numbers. So long-term investors must consider the fact that government constantly takes measures to keep the inflation in balance. It won't go up much, it won't go down much. And so during the inflation times, investors must avoid panic and emotion-based decision to sell off your stocks. But on the other hand, you have to look for fundamentally strong stocks and stay invested. And if stock prices are going down, invest more, buy on dips during that time. Your suggestions, comments are welcome. Please script it down in the comment box. That's all for now. See you in the next episode. Till then, bye from Anoop.